Welcome in, folks. Got a few things to react to here today on the Reaction channel. First up, Ulta beauty shares fall as company sees headwinds in beauty industry. Want to go over this? I think it's very important to discuss what's going on in that particular category, how it basically relates to ELF stock specifically, right? Which ELF stocks bit down big here today. So I want to speak about that, kind of go through that and talk about my opinions and perspectives there. From there, we're going to talk a little bit about the market. Tactically bullish thanks to market inflows, tech recovery, and soft landing, says Citi's Rob Lowe. So looking forward to reacting to that one. Then I want to react to this one. Market optimism on inflation is misleading. Okay, that should be an interesting one to react to. Then I want to react to this one. Never seen investors this afraid of a market that's doing so well, which is funny, and that is true, right? This is, I call it one of the most hated bull markets ever. Certainly the most hated bull market I've seen in my time since I've been in the market 16 years now. I've never seen this hated of a bull market over the last 2 years. So I think that's going to be a fun one to react to. And then the last one is this little 1-minute clip here from Kramer. I want to react to this one. The consumer has been extremely resilient. Spend continues to go up. Looking forward to what Wells Fargo CEO has to say there. Gonna have a free workshop for you guys as pinned comment today. Stocks to buy now for 2025. So that's going to be a free workshop. If you want access to that, I can email it over, send it over via text. That will be pinned comment down there today. Okay. Alrighty. So right off the bat here, this was definitely a headline on CNBC. Ulta Beauty shares fell on Wednesday as a company stuck by its current forecast and shared its longer-term financial targets. The beauty retailer's CEO, Dave Kimball, said the company is facing stiffer competition and a more dynamic consumer backdrop. So the shares fell as the company said it sees headwinds. No one ever likes to see that. And tougher competition in the beauty industry. As it hosted its investor day near Chicago headquarters on Wednesday, the specialty retailer stuck by its forecast for this fiscal year. Ulta said it anticipates net sales will range from $11 billion to $11.2 billion, and comparable sales will range from a decline of 2% to roughly flat. No bueno. I mean, Ulta, you kind of got used to this company growing same-store sales 6-9%, somewhere in that range. So when all of a sudden they're talking about a decline of 2%, no bueno. It said earnings per share will range from $22.60 to $23.50. For 2026 and beyond, Ulta said its financial targets will be 4% to 6% net sales growth and low double-digit diluted earnings per share growth. It said it expects mid-single-digit operating profit and operating margins of around 12% of net sales. Yet it did not provide specific outlook for 2025 fiscal year. I'm sure that's going to be coming probably in the first quarter of the year, right? In his opening remarks on Investor Day, CEO Dave Kimball said that this year has been more challenging than planned. Okay, does this surprise me? No, it doesn't surprise me. It doesn't surprise me at all. All these companies are facing headwinds this year. You just came off of two massive years where the consumer got destroyed by inflation, right? And so you come off of that, and guess what's going to happen? Sorry, my camera's all messed up here. Guess what's going to happen? You're going to face headwinds in your business if you sell to the masses. Who does Ulta sell to? The masses. The masses shop at Ulta, right? And when you have the bottom 60% of income earners get sliced and diced by inflation in 22, 23, doesn't come as a surprise at all, or shouldn't come as a surprise, that 2024 was going to be not a great year for all the consumer-related companies that sell to the masses, right? And we've seen it from company after company. Ulta, Nike, Starbucks, McDonald's. I mean, heck, even some of the soda companies have reported kind of troubling sales. The energy drink companies' sales haven't been that great. Convenience store sales, like, if you're going to slice and dice by people with inflation for 2 years, that next year you better be prepared because you're batting up the hatches. It's going to be rough, right? And that's exactly what we've seen in 2024. So although inflation has alleviated in 2024, the damage that was done in 2022 and 2023 can't be undone, right? So now the consumer can begin to come back to life in 2025, right? They're kind of being revived because inflation is not going to slice and dice them. But do be aware that inflation, we'll speak about inflation later on in this video, that could come back in like 2026, right? And hurt the consumer for the next leg. But for 2025, things are looking pretty good to the consumer. And I think a lot of these companies are going to report a lot better sales in 25. The Ultas, the Nikes, even people like Starbucks, and people assume like Brian Nichols a genius, like, oh my gosh, Starbucks sales are a little better in 25 than 24. It's not going to be because he magically made some change and Starbucks is back. It's just because the consumer is going to be able to afford more Frappuccinos in 25 than they were in 24 because they're not coming off a year of being sliced and diced by inflation, right? So what does this mean for ELF? Absolutely nothing. Absolutely nothing. At the end of the day, Elf's one of the biggest beneficiaries of the consumer actually being in a tougher spot and being in a situation where they need to watch their spending overall, right? And so Elf's benefiting from that. And Elf sells everywhere. So if Ulta sales aren't that strong, and let's say more people are shopping at Walmart, Elf's in Walmart, right? Walmart's sales are phenomenal. And Walmart, if anything's increasing market share, because a lot of people look at Walmart and they say, this is the cheapest place I can get beauty products, makeup products, cosmetics products. That's their view, right? And so if they shop at Walmart and buy Elf at Walmart, Elf benefits there, right? If they go to Target, Elf's there, massive sections, right? If they say, you know what, I'm going to buy it on Amazon. It's cheaper on Amazon than I can get it on Ulta. Well, there it is. It's on Amazon for you. So it doesn't matter where you buy it. Elf can sell their products well, right? So I read nothing into this. But there's a feeling, there's a sentiment that goes back to Ulta in Elf over time. And if I was to compare these stocks, it's very important you kind of see this, how these stocks compare over time. So let's pull up Ulta and compare it with Elf stock. And you can begin to understand the stocks move very similar. They move together a lot, right? I mean, look at this. This is, what did I pull up here? A 1 month or what is this? So on a 1 month, right? Elf's down 8%, Ulta's down 6%. Year to date, Elf's down 23%, Ulta's down 25%. Right? They're like twins, but on the upside, Elf has a lot more upside potential than Ulta, right? On a 1 year, Elf's up 2%, Ulta's down 6%. So the moral of the story is when people are feeling bad about Ulta, and therefore it leads them to feel bad about Elf. It's a complete mistake, but the moral of the story is if there's just an overall bad sentiment feeling in the marketplace for the biggest cosmetics retailer, which is Ulta, there's going to be a bad sentiment feeling even around Elf stock and all the others, right? If I pull up Estee Lauder is a dumpster fire compared to these two companies, but well, look at Estee. I mean, look at that baby, down 34%. So the moral of the story is Elf's winning. They're doing better than anybody else in the industry is doing, but it's a tough consumer backdrop, and people don't want to own these stocks when they view it as a tough consumer backdrop. And you might say, why isn't a stock like Cake being hit? With all this weakness, why is Cake? Well, here's the deal with Cake. Cake doesn't necessarily sell to the masses, right? Cake stock on a 1 year is up 38%, almost 39%. Cake doesn't deal with the masses. When we talk about Cheesecake Factory, they're dealing with more of the top 40% of income earners. Go to Cheesecake Factory, go to North Italia and Flower Child and their other restaurant concepts, right? So they're not a McDonald's, they're not a Starbucks, they're not counting on everybody being their customer. They're counting on that top 40, 50% of income earners. And for the top portion, things are just fine for those folks. It's the lower brackets that have been hit. So the lower brackets might say, I'm not going to Ulta. And so that's what you got to understand about this. We got a different consumer backdrop. And keep in mind, what you're seeing play out this year will not be the same thing you're going to see play out next year. So do keep that in mind. And a lot of these consumer brands, don't be surprised if they start to come back, specifically second quarter, third quarter, fourth quarter with their sales in 2025. All right, let's get into some market talk.
Citi's U.S. Regional Director of Research and Head of Global Strategy. Great to have you back, Rob. Welcome.
Thanks, Carl.
So you've not been tempted to increase your year-end targets like some of your peers.
By the way, in regards to Elf stock here, I did a video 8 days ago called Buy Elf and Celsius Stock and Don't Stop. And in that video, I talk about why Celsius and Elf, you're like nonstop buys for the next 3 to 6 months. And so if you're at all interested more in depth in Elf, you can definitely check out that video on the main channel. And then also last night I put out this move. The stock market is on the verge of a shocking move. You'll definitely want to check out that video because I think that's pretty eye-opening to a lot of folks.
No, but I mean, we do see a little more appreciation in 2025 as well. We're tactically bullish for a number of reasons. We think that there's still a lot of inflows coming into the market. There's also the tech recovery continues. We think you should be selective there. And also we're going into the elections, but for the most part, it's because markets have been pricing in a soft landing. And so we think that may continue for a little bit before we get to year end.
Who do you think the marginal buyer of an equity is right at this point? Is it money coming off of money market funds? Or
I think so. Yeah. I think there's a bit of that of having to get invested.
Mm-hmm. How about earnings?
Okay, that, but also keep in mind what is going on every single week. Well, people are depositing massive amounts of money into the market to in their retirement plans, right? So as long as there's a lot of jobs in the jobs market, that money keeps flowing in, especially from, guess what, the top 40% of income earners. That's where a lot of the money starts to come in, right? Lower income earners, they might not be putting anything away toward stock market investments. So they have no money going into the S&P 500 or the Russell or anything like that, right? But for the higher income folks, they always are flushing a lot of money into the market, right? And so, and then there's people like me, people like a lot of you guys watching this, that every week you're buying stocks, right? Every week I buy stocks. Every Friday I'm buying stocks, I'm buying stocks, I'm buying stocks, right? So that's who's out there buying. People that want to build their wealth, people that want to own great assets that produce big cash flows.
See, what's your growth look like for next year, let's say?
So, I mean, earnings may be challenged here a little bit. When we look at, 5-year free cash flow averages, they're peaking. So we would be challenged by earnings a little here, and we'd have to, the hurdle rates are going to be higher for you to get to a higher valuations. So that's one of the...
What you got to understand about a lot of these companies is as their revenue comes back, especially in middle to back half of 2025, what you're going to see play out is their profitability is going to go to the moon. Like I'm thinking about, there's a specific company I'm thinking about right now. Who is it? Nike. Nike, oh my gosh, starting around second quarter, third quarter, fourth quarter for Nike next year, their earnings per share is going to skyrocket because what's going to happen is their revenue is going to basically go the other way in terms of actually start going up for the company versus it's been going down, right? And as that revenue goes up, because they've been cutting so many expenses, even if their revenue is also up like 5% a quarter, you'll see their earnings per share up like 30, 40, 50%, like shocking numbers. Like, oh my gosh, like what the heck off of only 5% revenue growth? It's substantial in regards to leverage you'll get in that bottom line, right? And Ulta Beauty could be another great example of when all of a sudden their sales start to turn positive in terms of revenue. Oh my gosh, like in comp store sales, you know what's going to happen? Their earnings per share. You can see also in like revenue up 3%, but you could see earnings per share up like 14, 20%, like something like that, right? So keep that in mind. And so for a lot of these stocks, it's going to be what played out for tech stocks, right? Tech stocks, you look at the back half of 2023, all of a sudden their revenue started to go positive again, right? You look at NVIDIA's numbers, look at Meta's numbers, or, in their earnings per share, like 10x that number, right? If all of a sudden their revenue was up like 20%, next thing you know, their earnings per share was up like 200%, 100%, like ridiculous numbers. And that's what we're going to see in a lot of these consumer brands next year.
Challenging parts of the market right now.
That sell to the masses.
The election, do you think that's factoring in at all?
Not yet, Sarah. I think we could expect to see it. I think the way we're looking at it is fixed income markets and stock markets are really doting on the soft landing and Fed outcomes, and they're not quite entering into the U.S. election yet. I do think that we may start to see is the markets start to bring the Trump trade back a little more because of all the outcomes that you have to think about in terms of the election. A red wave with the Trump win is, whatever probability you assign to that is one that could affect policy change the most. And so I think clients will start to, or institutional clients will start to hedge that a little more as we get closer to the election.
Do you think?
Wait just a flippin' flapjacking moment. Did this man watch my video last night? Did he watch my video last night? Like, what in the world's going on here? Holy smokes.
I think that's why we're seeing a move in small caps, I wonder, higher, because if you look...
Oh my gosh! Are they not watching my videos? This is getting suspect. No, this is getting really suspect.
Beneficiaries of lower corporate taxes, for instance, and deregulation,
right.
I would think it's some of those smaller domestic companies.
Yeah, Sarah, I think you're right there, but I think that's also the effect there is also the soft landing, pricing in a soft landing for the economy. So I think small caps could benefit from that as well. So it's partially the election, but it's also, or a potential election outcome, but it's also it also has to do with the soft landing as well if it happens.
You mentioned tech, and I know you've been overweight semis, for example. Did this news this week about ASML and worries about new...
I don't think people understand how to call a soft landing. You can't call a soft landing in 2025 either. The soft landing, if we have it or don't have it, will be 2026 and 2027. That's when you're going to be able to make the judgment on, oh yeah, we had a soft landing or we didn't. We just started the rate cut cycle. The rate cut cycle is going to go throughout 2025. So come 2026, 2027, that's when we're all going to know, did we have the soft landing or did we not have the soft landing? You don't know in 2024. You can't call it a soft landing yet. You can't call it in 2025. 2026 and 2027, Yes. If the economy is great still, unemployment's under 5%, inflation looks great, come 2026, we had it. We landed. We did the soft landing, right? If it's not, and all of a sudden unemployment's going boop, 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 up, 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 okay, we didn't have the soft landing after all, right? We had a medium landing or a hard landing or something like that, right? But you can't call it this year and you can't call it next year.
And upgrades XAI. Do anything to change that house view?
The house view on AI, I think, we still feel that AI has legs. And as you know, last time I was here, I was big on the digital transformation of the economy. And we're seeing it, especially with the demand for nuclear energy and power grid. I think we have to be selective here. We like semis still here, as a recovery play, but we're kind of underweight on software. So, we have to play that. We would even be more selective with the Mag 7.
And then we're looking at this table here of your view on crude, where, man, the polarity between 50 and 100 and all the good arguments you can put together to argue for both at this moment.
What we did there is we upped our bull case to $125 a barrel in the event that geopolitical issues really get out of hand. And even though Israel said they wouldn't be striking any of the oil areas, there's no telling how that could play out. We're actually bearish. So our year-end target is $74 on Brent a barrel, and then we think it goes to 65 next year. I think we're really pretty much in consensus with that. Maybe we're a little more bearish, but we did have to up our bull case scenario in case of geopolitical
where it's very difficult to
read. So we kind of would avoid it too.
Right.
Man, I could tell you 125 for oil would not be fun. That would not be fun. If you want to talk about something that would send the market down huge, send oil to 125, because that's going to reignite inflation fears in an epic way. So let's hope that does not happen. Unless you're rooting for the market to go down, of course, right? But yeah, 125 oil. If that happens next year, it's going to be a bloodbath.
Is the economic data comes in fine, the Fed's cutting rates, and inflation doesn't perk back up too much, path of least resistance is higher?
Well, path of least resistance has some bearing on its valuation as well. And we did a note 2 weeks ago saying that the market looked like it was about 2 multiples too high. Each multiple is about $250 of S&P earnings on a forward basis. So that's about 500 points. The S&P would be worth about 53.50. But you're right. Unless we have some clarity on whether it's an extreme soft landing, yes, in the middle, but you could have a hard landing. You could easily have a no landing, which would take rate cuts off the table next year. I think the risk is pretty high right now.
So you think the risk is high of a correction on the idea of a no landing? Because even if it's a no landing and you don't get rate cuts, the market might not be thrilled with that, but it does mean that the economy is in great shape.
Well, a really detailed analysis of inflation, which in this brand new era of populism is not going to stay quiescent forever. In other words, the 2% inflation target of the Fed on a long-term basis is over. It's dead. It's gone. We're in a valley between two moves in inflation. The next one won't be as high as what we saw in 2022, but we're just in a valley, and it's a misleading optimism in the market to believe that inflation's been whipped. We're going to see quite a bit of fiscal, no matter who wins the next this election, quite a bit of fiscal, because that's what the public demands. They want fiscal.
Well, the bottom line with inflation, you can never make a long-term judgment on inflation, right? You can make a 1 year to maybe 18 month. The bottom line is inflation is dead right now. Inflation is going to remain dead until at least summertime of 2025. I think summer 2025, then we can talk again about maybe inflation is coming back, maybe it doesn't, right? A lot of that depends upon commodities, what happens to the price of oil, all those sorts of things. But inflation is dead for now. Like, it's been dead. It's been dead for at least 6-9 months now, right? And it's going to remain dead till summer 2025. And then we can talk about inflation again. So, but yeah, if you're trying to make a multi-year call on inflation, like, you just can't do that. You can't, like, that's impossible. Yeah, like, no one has a clue where inflation will be 2 years from now, 3 years from now. It might be 1%, might be negative, might be 3%, 4%. Like, no, you can't do that.
The market rejects it, of course. So, Barry, what do you do? What are you telling your clients to do if you think the market looks too expensive and you're worried about spending, which could hurt bonds as well?
Well, think about the bonds. Yeah, there was a slight move after the strong payroll number, but total government debt held by the public is only 30% of non-financial debt. That's actually fairly low. And we have no term premium in the market, meaning the cost or price of duration risk. That means that the yield is actually very low on 10-year treasuries. So we could issue more debt, and I think the politicians know that. So as far as we look out into the future, we think valuation is just very stretched. We are following a composite of past bubbles, so we could go higher. But unfortunately, when the inflation perks up and the Fed mid-decade is forced to reckon with that, then we're going to go straight back down. And it kind of begs the question, what's the point?
All right, Barry. Well, it's an alternative view. Thank you for joining us, though, with it. Appreciate it.
Thank you.
Highlighting some of the risks out there. Barry Bannister of Stifel.
Yeah, I always appreciate that. All right, next one here. Never seen, and by the way, I love these kind of negative viewpoints because it shows you that, there's a false assumption out there of like, oh, everybody's so bullish. Baloney. I react to people all the time on this channel here that are not bullish on the market, that hate this market, that are not in favor of this bull market, that talk trash about this bull market. Oh, it's only 7 stocks, and it's just like, I love that. What I'm going to dislike is if everybody's on the bullish side. And because once everybody's on the bullish side and you really don't have much pushback at all to the bearish side, then it starts to feel toppy, right? Because then it's like, where's new money come from? But as long as you got these bears over here, talking all these negative points and things like that, there's always more money to come over, right? So it's just something to keep in mind there. I always appreciate kind of bearish points. Next one up here, never seen investors this afraid of a market that's doing so well.
He's the CEO of IG North America, and he joins us this morning. And what's up, JJ?
Hi, Beck. How are you today?
Good. How are you?
I am well, thank you. Interesting couple of weeks coming up here now with earnings, right?
Yeah, you got earnings as we head into an election, and everybody's wondering what the Fed's actually going to do next.
He said Beck. They must go way back.
For an interesting trifecta.
And we have, 46 new highs, and it's the market that nobody actually loves, so we continue to go higher, and quite honestly, we probably can continue to go higher because I've never seen a market that's doing so well that nobody talks about and everybody's afraid of. And again, path of least resistance is what I always believe in, and the path of least resistance, in my opinion, continues higher because there's absolutely zero FOMO on the upside right now.
Yeah, there have been 46 new highs, I think, for the S&P 500 this year.
Zero FOMO on the upside. I gotta agree with him. There really is. Even myself, I don't feel like, oh my gosh, I have to do something crazy in regards to leverage positions or anything like that, or buy calls. No, I'm fine with doing my weekly buys, adding my portfolio, building it up, sweet. And so, yeah, I look out there and I definitely don't feel the FOMO out there. Not in this market. But as I spoke about on the main channel, Financial Education, last night, that could change substantially, quickly. So as of right now, FOMO market, no. Could it change? Whew. After you watch that video, you kind of begin to understand what could transpire here and how that could change things epically.
Jamie Dimon said something maybe about a month ago about how people forget that markets can go down too.
Yeah, you say that, but then you look at the people who are in their mid-30s, et cetera, and younger, they've actually never truly seen much of a down market. When they think they see it, it only lasts a few days.
Right.
They've never had it. So if you are a younger person, I think it's awesome in the sense that when you're younger, we always tell people to take risk. It's kind of a funny conundrum to me. We tell people to take risk, then when they take risk, we actually criticize them for it at times, which is very odd to me. But if you are a younger person and you're willing to take a little bit of risk, it's actually been an incredible run for you, and you've had an opportunity to make some money. Now, again, if you've done so, hopefully.
Thank you, sir. It became part of the 1%. Thank you to that. I appreciate that, sir.
Keeping your risk in balance, so to speak. But this is, when I talk to a lot of our younger clients, et cetera, they really are like, this is amazing. And the great thing about it is long term, I think it's great for the market because you got to remember, they're the people who saw their parents have a tough time in 08 and 09, but they themselves are experiencing success. So they're starting to have a much different view of the market overall. Long term, I think that's fantastic.
I've been kind of...
Yeah, and it depends on when you start investing, right? If you're 35, like I'm about to turn 35, right? and you've been in the market 16 years, you've seen plenty of drops. If you just got started with investing, and let's say you're 35 and you've been investing for 1 year, 2 years, a whole different ballgame there. But let me be quite clear. I've seen plenty of some of the most insane drops you've ever seen, right? When I got started in the market, it was during the great financial crisis, right? We all know what that was. That was, insanity. We had several different corrections in those sorts of markets over the years, kind of coming off of the great financial crisis. Late 2018, we had a significant drop in the market that was pretty dang violent. I mean, you saw a lot of stocks go down 20, 30, 40%, a lot of the big tech stocks in a matter of months. That fourth quarter was vicious. We were on pace in December. I remember December of 2018, we were on pace. There was headlines everywhere. We were on pace for the worst December since the Great Depression in that particular December. So that one hit me hard. Like that was violent, right? Then we had the 2020 drop, which was it long lasting? No, it lasted like a couple months, but that was scary. Like it was like day after day after day, it seemed like stocks were down 5, 10, 15%. Like stocks lost, 40, 50% of value quick in that one, right? We came back quick, which was nice, but it was vicious at the time. Then we had the 2022 drop, a much longer drop. Peak to trough, that one, as far as the Nasdaq went, Nasdaq fell about 37%, which, let's be honest, people are invested heavy in the Nasdaq stocks nowadays. And many of the biggest Nasdaq stocks were down 30, 40, 50, 60, 70% peak to trough. Let's not act like that was a small drop. Like that was an epic drop. Like that was, not quite tech bubble drop, but dang, not that far away. That was extreme, right? And the difference is the tech bubble, there was a lot of like kind of joke companies in that time. This is like the most powerful companies in the world you saw, like the most invested companies dropping like that. And that was a long drop. That was around a year-long drop. The drop started in the fourth quarter of 2021 and ended in the fourth quarter of 2022. So let's not kid ourselves and act like that wasn't significant. That was, once again, that was about a year long, which was vicious. So if you've been investing for the past 15, 20 years, you've seen plenty of drops. If you just got in the market in the last 2 years, sure, you haven't seen a drop yet, a significant drop that is, right? You saw little minor ones here and there, but you haven't seen like, whoa, like what the heck's going on? But so it depends on how long you've been investing. You've been investing like me, you've been a lot of damn crap. I'd say that.
If part of the reason that this market has such strong legs is that...
And don't ever fear that. That's just part of the game. This is part of the game. These market drops, like it's going to happen. Like I'll see... Like the next 16 years, there'll be plenty of major market drops. Like there'll be crashes, there'll be corrections. It's just part of the game.
There have been so many people who are maybe a little older who have gotten burned in the past who have been waiting for a pullback. That pullback has never come. And maybe you have more and more people who kind of capitulate over time. Like, okay, I got to throw in the towel and get into this.
I would say maybe a little bit. But one of the reasons, as I started with, that I think we continue higher is if they're going in they're still going in very...
Just dipping their toe in?
Yeah.
A little bit at a time.
A little bit at a time. And I think to your point, there are some people who are so underinvested, and that's usually the time the markets continue higher. Again, people don't truly believe. And everyone I talk to is so nervous. The Fed's been a tough story. Mm-hmm. People are unsure what to do there.
Although the Fed is now in a massive easing cycle. So.
Well, yes, they
Whether
are.
we get a cut at the next meeting or not.
Somebody hasn't told the bond market that the last week or so.
Right.
And so with that also, again, the election, we did a study recently, and it showed that actually volatility isn't that much greater in election years than it is in normal years.
Well, volatility is great right now.
Yeah, I mean, at 20, historical average, basically.
Yeah.
But
it's only recently come up to 20.
Exactly. If you look at the year after elections, that's when volatility actually starts to increase a lot more than the year of the election.
When they actually start making changes for whatever administration wins.
Yeah, exactly. And can they actually get anything done? And so we'll see in, just a few months in January if that sort of holds true.
All right, next one up here. And by the way, his sentiment I 100% agree with in terms of just like a very hated bull market we're in. A lot of people are not feeling that FOMO in this market, right? Are kind of like, if you are optimistic, you're kind of cautiously optimistic. But once again, that could be changing very soon. Watch that video from last night if you want to learn about that.
Just in general, the state of things in the country, where I know you went over and over again in all your conference calls, you stress hiring, employment is good, inflation is running down. It just seems like a halcyon time. But we always know it's a bank. But we always know, but we do feel when I read you, you're very optimistic.
Listen, what I know is what we see. We have the facts in front of us. And the facts are the consumer's been extremely resilient. Consumer spend still continues to go up at a very measured pace, both in debit card and credit cards. When you look at deposit balances are still strong. Credit quality is still performing extremely well. Corporations went into this environment with very, very strong balance sheets. And so the facts are that things look pretty good. And the Fed has done a great job of managing this down under circumstances that people said were extremely difficult. So that's what we see. And so, yeah, we're pretty optimistic. We're conscious of the risks that exist in the world. We don't sit here and say risks don't exist. But what we see looks pretty strong.
Don't miss it. So, if everybody's trying to figure out when the big crash happens, when does a big one hit, right? The real crash in the economy, unemployment goes 7, 8, 9, 10+%, right? When does that happen? I'll tell you exactly when that happens. If we get round 2 of inflation, after that, boom, that's when you get the big one. We could withstand the first round, right? We could withstand that. We got through the first round of inflation. Did the consumer get damaged? Absolutely, especially the bottom 50, 60% as we spoke about, right? And we've seen that play out in 2024 and all these major company numbers that sell to the masses. But we've made it through. Now, if, let's say, oil goes crazy in 2025 and inflation starts running rapid again into 2025, rents start going up big time again. If you had something like that in 2026, in 2027, that would be the death blow to the consumer, essentially. And that would be the moment that we would get the big one, the big crash, the big unemployment cycle, all those sorts of things, because the consumer wouldn't be able to withstand another big round of inflation. They'd be able to get through this one, but another round, a year from now or something like that, couldn't do it. Couldn't do that one. That would be the big one. So just keep that in mind. If we don't have that big round of inflation and let's say, CPI stays, 3% or under for the next year or two, I think we're looking good because I think wages will outstrip CPI. So that would be good overall, right? If wages, let's say, are going up 4% on average over the next couple of years, 4 to 5%, but CPI is running 2 to 3%, we're looking good. It's more like what happens if all of a sudden CPI went 4, 5, 6% again, 7%. Never mind if it went to 9% plus like we were in 2022. That's done. Like we're finished in that sort of situation, right? But the other reason it would be very vicious if we did have another bout of inflation, it's not just the damage it does to the consumer, but then the damage it does to the stock market and real estate, because then we'd be talking about the Fed can't lower rates and the Fed might start raising rates again. If we have all of a sudden that fear come in, and that's like a serious fear, the market's going to get destroyed. Real estate will get destroyed. Real estate's kind of floundered through this situation, but I could tell you if we went through another hike cycle, real estate's donezo in that, and you would see prices drop significantly. Then we get into more of like a deflationary type recession. That would be ugly. But that game has to play out, and we don't know if that game's even going to play out or not. And you don't begin to start to understand if it's going to play out till at least late in the spring of 2025 or the summer of 2025, and then you can start kind of seeing if the pieces are there for this game or if it's not, right? But if you're wondering, the big one, that's the big one, okay? Appreciate y'all joining me as always. Hope you enjoyed today's video. Hope you got a lot of value out of it. Pin comment down there, stocks to buy now for 2025 workshop. I can email that over to you or text it over to you, whatever you want to receive that. If you want to get that free workshop, definitely enjoy that. And other than that, make sure you check out that new video I put on the main channel last night. The stock market's on the verge of a shocking move. I think that's going to be a helpful one to you. And if you care anything about Elf stock, I got that one for you guys there on the main channel from 8 days ago. Much love and have a great day.